Hello friends, this is Vijay Bhambwani here. I hope you're doing well in the markets and these weekly market outlook videos are helping you trade the markets better. Well, last week we saw the markets climb over a wall of worry as the Chinese credit crisis basically for now at least remains under control, and the other countervailing force was that the US Federal Reserve said it would not taper meaning curtail the bond buying, which is a kind of a stimulus by itself. It would not curtail bond buying for now, and the bond purchases would continue therefore. And the money tap remains open. So on one hand, you had the Evergrande worry. On the other hand, the bigger trigger was that the US kept the money tap open. And guess what? The market chose to pay more attention to the positive and therefore rallied. Let's now dive right into what happened last week and how we can gauge based on that as to what is likely in the coming week. Now, before I proceed, there are two updates for my viewers here. One is I want to clarify as to why I mentioned the 25 period exponential moving average. I've explained that in the Bank Nifty segment so that my viewers can understand why I use such a very simple tool. It's actually deceptively simple. And the other is some people have asked me as to why, when those 5 stocks that I have mentioned, which are high beta, high impetus, and 5 stocks that are low beta, low impetus, why don't I mention the direction in which they must trade those counters? So I will tackle both these issues about the 25 exponential moving average in the Bank Nifty space and the direction of those 5 stocks in the fag end of this video. So don't go away. Let's dive right in. And the market roundup window, the graphic on your screen shows that the Nifty outperformed the Bank Nifty and the dollar continued to rise on safe haven buying. And the dollar strength basically exerted downward pressure on bullion, but oil remained firm. And that fuels inflationary fears in emerging markets. But it's a tiny worry. As you can see, the markets are shrugging off all bad news. The 10-year benchmark bond yield remained unchanged, and the coming graph on your screen shows the market-wide position limits, that is the open interest nursed by the traders, which continued to rise. This is routine till the 3rd week of the derivative series. And in the expiry week, it kind of peaks out and then starts to fall. So the MWPL rising is nothing untoward. Now coming up on your screen is the basis chart. Now basis means the premium enjoyed by the futures over spot. Now the basis chart on your screen shows the premium on both the indices fell, which is partially due to the approaching expiry on Thursday. On expiry day, futures tend to converge or meet the price of the spot segment. And therefore, the basis falling is nothing really surprising. Now let's take a look at the volumes chart. Now, this chart basically takes into account the futures of September, October, and monthly November 3 monthly cumulative turnover. And this chart shows that the traders were very clearly active on stock futures rather than index futures. Now, part of the reason could be that the pre-expiry rollovers were responsible. However, whenever traders tend to be more focused on individual stock futures, it shows a higher risk appetite and therefore further upsides likely in the market. Let's now go to the impetus chart, which has been a bedrock, a solid anchor around which we have at many times gauged the strength in the underlying market. This is an in-house exclusive study from our in-house statistical models. and it's not available anywhere in the public domain. So the impetus chart on your screen tells you that the Nifty 50 gained momentum, which is very clear, and the Bank Nifty momentum or the impetus was languishing. It's not therefore very surprising as to how the Nifty actually outperformed the Bank Nifty. Ideally speaking, I would want the Nifty's impetus to rise even higher so that upside momentum can accelerate from now. We'll watch this metric on a day-to-day basis as trading progresses. Now let's take a look at the footprint of the various market trader classes. First, we start with the FIIs who cut their index futures longs to 32,206 lots, which was last week 63,220 lots. Their stock futures exposure rose marginally to 2,78,817 lots, which last week was 2,68,853 lots. The DIIs, the domestic investment institutions, they cut their index shorts very mildly to 89,879 lots short, which was earlier last week a short of 94,812 lots. And their stock futures shorts rose to 12,62,206 lots, which last week was 12,49,207 lots. Let's now take a look at what the prop traders were doing. Now, the prop traders continued to reduce their stock futures long exposure, which is now at 1,08,069 lots. Last week, it was 1,31,732 lots. Their net index futures longs are now at 3,128 lots. Last week, they were short by 10,186 lots. Now, let's take a look at the most anticipated segment, the retail traders who've been basically doing all the heavy lifting and buying in the markets. They continued to build their fresh long exposure as their stock futures longs remained at a period high. Now, this graphic is a 20 session kind of look back period. Now their individual stock futures longs are at 8,75,320 lots. Last week it was 8,49,422 lots. Their index futures longs rose to 54,545 lots, which was last week at 41,778 lots. Friends, let's now come to the 10-year benchmark bond yields. And as you can see on your screen, the bond yields remain constant, absolutely unchanged at 6.18%. The bond markets shrugged off the Chinese credit crisis news and they focused on the US tapering news instead. Oil prices, which rose last week, is not exactly welcome news, especially for emerging markets, because we tend to be sensitive to imported inflation. Inflation triggered by higher prices of landed imported goods. Now, oil prices rising is, of course, another worry for the bond markets because oil is a multiplier commodity. Whenever oil prices rise, everything from fruits, vegetables, pulses, meats, eggs, etc., everything becomes dearer. And other than this, there is not much by way of any bad news on the bond market front. So banking stocks and the Bank Nifty by extension should be doing fine in the week ahead. Watch this space very keenly in the coming days. I keep updating this data on my social media accounts, so do connect with me. My contact coordinates will come at the end of this video. I'll be updating a lot of market sensitive information at the end of the day on these accounts. Friends, let's now go to the US dollar index. This currency benchmark, as you can see on your screen, rose on a week-on-week basis. And it rose on 3 out of 5 trading sessions. and the bullish days were significant enough to log net gains. Note how the 93.5 level, which I have been advocating as a resistance, is still in place and acting like a hurdle for the bulls to overcome. Now, the price remains above its 25-day exponential moving average, which means the short-term outlook remains positive. Now let's take a look at the weekly chart, which shows the index logging a smaller candle, which is yet to clear the hurdle denoted by the red dashed trend line. The price remains above the 25-week exponential moving average, which means the medium-term outlook remains positive for the US dollar index. Now, the dollar bulls must offer proactive support to push prices higher. And do note, I remind you again that a higher dollar is negative for emerging markets, including India, due to the imported inflation. Now, last week, I advocated a range between 94.20 and 92.15, which held perfectly well. The coming week is likely to witness an estimated, I stress upon the word estimated here, range between 94 and a quarter on the upside and 92.30 on the downside. I would suggest you watch the US dollar index space very, very keenly. Friends, let's now go to the Bank Nifty, which rose 0.05% on a week-on-week basis. It clocked gains on 3 out of 5 trading sessions, but it failed to surge past the previous week's high, as you can see on your graphic screen right now. Note how the price stays above its 25-day exponential moving average, and like I told you, I want to make you understand what the significance of this 25-day exponential moving average is. The importance of this seemingly, I'm using the word seemingly, simple tool cannot be emphasized enough, because this level is approximately the average cost of bulls who have initiated or executed long positions over approximately one month's time frame. Now, as long as the current market price remains above the average, which is the monthly average buy position price, traders are tempted to remain long and even maybe buy fresh longs. Now, that keeps the market going higher. Now, do note how Tuesday's intraday low last week was exactly at this exponential moving average itself. Now, switching on to the weekly chart, we see a smaller candle contained within the prior week's range. Here again, the price remains above its 25-week exponential moving average, and the outlook is therefore tilted towards the bulls, provided the bulls also offer some more follow-up buying support. Now, in the week gone by, in the week before last, the index was placed at number 2 on the most volatile list, but it fell 2 notches to number 4 because of lower impetus, as we've seen earlier. Now, last week I advocated a range between 39,200 on the upside and 36,425, which held perfectly well in spite of all the volatility. And the coming week is likely to see an estimated, I stress upon the word estimated, range between 39,250 on the upside and 36,425 on the downside. Friends, I would suggest you keep trading on lower volumes and maintain stop losses very diligently. The volatility is likely to be fairly escalated, if for nothing else, due to the simple base effect. Now, do remember that both the indices are at near lifetime highs. So therefore, even a 2% volatility can actually set you back by a large sum of money. So do trade carefully, maintain stop losses here. Friends, let's now go to the Nifty 50, the most liquid derivative counter out there on the NSE derivative segment. The index rose on 3 out of 5 trading days last week, as you can see on your daily chart. The bullish candles were far more kind of prominent as compared to the bearish ones, and the index actually outperformed the Bank Nifty on a relative comparative basis. The price remains above its 25-day exponential moving average, whose importance I explained to you in the Bank Nifty space. Now let's take a look at the weekly chart on your screen. It shows the last candle being a fairly prominent one, which is validated by the higher impetus chart, which you saw earlier. Now, the price stayed above its 25-week exponential moving average, which means even the medium-term outlook remains positive for now. Now, in the week before last, this index was number 17 on the most volatile list, but it rose 3 notches to end the week at number 14 because the volatility, as I told you in absolute terms due to the high base effect, is rising. Now, last week I advocated a range between 18,050 on the upside and 17,125 on the downside, which held perfectly well. Now, the coming week is likely to see an estimated, I repeat the word estimated, range between 18,300 on the upside and 17,400 on the downside. Now, since the volatility, like I told you, is likely to be high, I would suggest, my friends, that you trade on lower exposure levels and maintain your stop losses very, very strictly. Friends, now the indices is done. Let's move to the stock high beta, high impetus and low beta, low impetus stock segment, wherein I give you 5 stocks from each segment. Now, high beta, high impetus stock list, wherein you will take small exposure and wait for large price moves. The list is led by Godrej Properties at number 1, number 2 Bajaj Finance, number 3 Bajaj Finserv, number 4 McDowell's, and number 5 Balakrishna Industries. Now, low beta, low impetus stocks list is led by Voltas at number 1, number 2 IRCTC, number 3 Naukri, number 4 Syngene, number 5 Power Finance Corporation. Now, this is a list where you take high exposure and wait for small price moves. Why the different advocating different strategies? Because different traders, different mindsets, and therefore different techniques. Now, friends, not only do I need to tell you an update about how and which direction to trade in, the link to which direction you will trade is based on a previous video, which you will see in the link up on there if you're watching this video on your laptop or desktop. If not, you can go to the description below the video itself, and in the description segment I've attached the hyperlink to the previous video wherein I give you a very simple hack on screen reading using the snapquote window. Now, if the price is staying above a certain level, which I've explained to you in that very small video, you will trade long and vice versa. So now you have it. You don't even have a problem about which direction to trade in these 5 counters. Now, do remember that this hierarchy can change hour to hour because volatility is always rising and falling. So do check back with me on my social media accounts wherein I update this data on a day-to-day basis. So you stay abreast of what's happening in the market. My contact coordinates will come at the fag end of this video. Now, friends, if you liked this video, do subscribe to my YouTube channel if you haven't already done so. Please let me know in the comment section how you liked this video and what you like about our work out here. Share this video with your family and friends and help me reach out to fellow like-minded investors and traders. Also, in the description below the video is my hyperlink to my playlist on Equity Masters YouTube channel, wherein I put in a couple of ideas every week. Also is an offer to get a free trading guide from Equity Master, which I think is a fantastic offer to avail of. It's absolutely free. Friends, I thank you for your patience in watching my video, and I wish you have a very, very profitable week ahead. Till we meet again in my next, this is Vijay Bhambwani signing off for now. Take care. Bye-bye.